Hello and welcome to the Tax Roundup for April. This month we're going to take a look at the new foreign resident withholding tax, that 10% tax, and what the implications are because the ATO has just released a new guide. We're going to take you through a tax case where the AAT had to assess 216 separately denied deductions by the ATO and what the implications of those are. But first up, Michael Carruthers is going to take you through a new form of guide that the ATO has released. And first up, it's looking at those new small business rollover restructure rules. Across to you, Mike.
Now, for anyone who's really excited about the passage through Parliament of the brand new rollover relief for small business restructures, I've got some more good news for you, which is that the ATO has already started issuing some pretty formal guidance in terms of the practical application of those rules. Now, this is an interesting area in itself because quite recently the ATO has begun issuing some brand new forms of public guidance to taxpayers. One of them, which the ATO refers to as Law Companion Guideline Documents, LCGs. The other one is called a Practical Compliance Guideline as well. Now, we won't go into that in too much detail today, but it really briefly, those PCGs, are basically aimed at identifying to taxpayers what would be a high-risk situation or a low-risk situation. In the past, we've had the ATO release publicly practice statements, but those, if you read them, they're really aimed at ATO staff. It's the ATO saying to their staff, this is how you should apply the law in this certain situation. These are the things to be on the lookout for in terms of high risk or low risk situations. So these new guidelines are similar, but very much aimed at a taxpayer audience, not an internal audience. So this will be the format, I guess, the ATO uses in terms of communicating where they're going to spend their money in terms of compliance resources and their effort, and what you might do to stay under the ATO's radar. Now, the first type of guidance I mentioned is these Law Companion Guidelines, and it's quite an interesting concept. What happens is when new legislation is released, and it won't be all new legislation, but where it merits this sort of approach, the ATO will actually work with Treasury, who are sitting there drafting up the legislation. At the same time, the ATO will be drafting up these Law Companion Guidelines, with the aim being that once the legislation comes into effect, we've got the bill, we've got the EM, which is, I guess, the government's kind of ideas behind the legislation. We'll also have these Law Companion Guidelines, which is the ATO's view on the practical application of the rules to various situations. And you can expect to see lots of examples in those companion guidelines. So straight off, we've got a couple of draft Law Companion Guidelines dealing with the new small business restructure rollover rules that will apply from 1 July 2016. One of those guidelines looks at the practical application of the rules. So when you choose rollover relief and you've met all the conditions, what impact does that actually have for tax purposes? And the draft guideline just runs you through 5 or 6 different examples and explains how the ATO would apply the rules to a number of different practical issues. The other one looks at a key concept within the new restructure rollover rules, and that is whether the restructure is of an ongoing business. Is it a genuine restructure of ongoing business? And that is one of the fundamental concepts contained within the new provisions. And so this guideline looks at situations that the ATO would expect would qualify and meet that condition, and situations where they think practically wouldn't pass that condition. So giving us, again, a bit of an understanding of what might look okay and what might not look okay to the ATO. Now, again, this is the ATO's interpretation. You're free to disagree with it. If you do so, you'd probably just want to be aware that the ATO's got that view there. So I guess in terms of doing your research around tax issues, as well as looking at legislation, the EM, public rulings that are on the ATO legal database, also need to start being on the lookout for these new types of guideline too, because they might just help shape the answers that you're coming up with and help your clients work through situations in a bit more of a practical way.
From the ATO this month, Ray is going to take you through that foreign resident withholding tax, the information that's been released, and some of the timing issues that are likely to occur before the tax is introduced on 1st of July.
So anybody dealing with foreign residents entering into capital transactions where the foreign resident is the vendor, there's now a bit more paperwork to be taken care of and a few more things to be put on your to-do list. The non-final 10% withholding tax will be taking effect from the 1st of July 2016 in relation to any transactions on or after that date. So there are some specific carve-outs in relation to things like sale of real property where the value is less than 2 million, but in general, this will have to be dealt with when any time the vendor is selling something that is taxable Australian property. Now, where the vendor is going to be exempt because they're an Australian resident, for example, they have to provide a certificate of clearance stating that. And that has to be provided to the purchaser or possibly their real estate agent or possibly their solicitor. So a little bit more communication between those parties would be a good idea. If that has not been provided on time, the purchaser is required to withhold 10% and then pay it across to the ATO as soon as possible. Now, if the foreign resident will be subject to some tax, but not necessarily 10%, they can apply for a variation to have that amount reduced down. So for example, if they have capital losses carried forward. However, there are these 3 specific forms that would need to be dealt with: the certificate of clearance application, which will be done online, the variation request by the foreign resident, or the purchaser when they are remitting amounts to the tax office. Unfortunately, those 3 forms are not yet available. They will be made available online before the 30th of June 2016, but it's a little bit of a problem if you're trying to plan for transactions now that will complete in early July, for example. How exactly do you build that into the contract? So that's something that's going to encourage a lot more discussion between the tax agents, the legal advisors and the real estate agents to make sure some poor vendor who just happens to be a foreign resident will not be stuck with a lot less cash than they expect from their CGT event.
In cases, Mike's going to take you through the Zhang case, which looks at those 216 separate tax items.
The case we're looking at this month is Zhang and the Commissioner of Taxation. Now, this case dealt with a taxpayer who was a director of a number of companies in the corporate group, and was also described as the controlling mind of that business group. Now, what had happened is over a number of years, the ATO had conducted some tax audits on this taxpayer, and the ATO was a bit concerned that this particular taxpayer hadn't declared enough income in his tax returns. What the ATO had noticed was that there are a number of transactions that were not being treated as income in the hands of this taxpayer, but to the Commissioner really did look like income from a tax point of view. We're talking about things like where the company or one of the companies in the group had paid or made loan repayments on behalf of the director, the taxpayer, but this had never been recorded as income. There were situations where third parties had transferred funds into the taxpayer's bank account and Commissioner suspected that this was really just income but hadn't been reported as such. Situations where the taxpayer had gone out and spent money on a credit card but the company had paid the credit card bill. So there are a range of transactions where the Commissioner thought, well, this looks like income, it hasn't been reported as income. So the ATO actually amended assessments and significantly increased the taxpayer's taxable income. The Commissioner also applied penalties in respect of the unpaid tax. Now, the taxpayer had objected to those decisions and the matter ended up before the AAT. What the Commissioner had done had gone and identified a series of transactions, and there were actually 216 of them, which were in dispute, where the ATO said, these 216 transactions we think are all assessable income, where the taxpayer was saying, no, none of those are assessable income to me. There's something else. They're loan repayments, for example. So the AAT had to kind of work through these transactions, look at the evidence that was available and see whether the taxpayer had proven that these amounts were not income. Now, of the 216 transactions that the AAT was reviewing, and these were kind of broken down into a number of categories, the AAT was only convinced by the taxpayer on one of them. So all the others, 215 other transactions, the AAT said, look, we're not satisfied that this is not income, so we're going to default to the Commissioner's judgment on this, which is that these things are income. Now, the case demonstrates 2 pretty important things. Firstly, evidence. Evidence is absolutely crucial. This taxpayer did not have evidence to substantiate the arguments or the assertions that they were making. So the taxpayer would say, well, I lent all this money to the company and then when money got transferred back to me, that was just a repayment. But the taxpayer couldn't provide sufficient or adequate evidence to show that the loan had actually been made by him in the first place. Now, there might have been evidence that maybe some amounts were provided to the company, but it might have been by someone else, or maybe there just wasn't evidence of those funds being provided to the company, and certainly no evidence that it was provided as a loan. So lack of evidence was really crucial here in the taxpayer not being able to back up the arguments they were making. And that's a really important point. Lots of cases are won or lost on the quality of the evidence that can be provided to the Commissioner or to the courts or the AAT. The second one is something that we've seen a bit of a trend on in the last couple of years, which is the ATO looking at directors of companies in particular and identifying situations where funds or benefits are being provided to those directors where they're not being reported as salary, wages, directors' fees or dividends, but where the ATO is saying, well, look, those things have the character of income. This company is providing you with a benefit. It looks like it's being provided in your capacity as a director or maybe an employee of the company. And in the absence of any proof otherwise, we are going to just have to conclude that these things really are in the nature of income. This is not a Division 7A issue. This is not necessarily looking at these things as a dividend. This is the ATO just saying, look, you've been provided with this benefit. It's been provided by a company that you have this control over. You're a director of the company. We're going to have to assume that these things are income unless you can prove otherwise. And we come back to evidence. There just wasn't enough evidence in this case to prove that those amounts were not income. As a result, the AAT said Commissioner's decision, other than that one item, should stand, and also the penalties were appropriate. So, big win for the Commissioner, I guess, in this case, but it really does drive home a couple of those key points, and something that particularly practitioners should be on the lookout for in terms of their clients. One, the importance of good, clear, contemporaneous record keeping and documentation, and the other one being very careful about the nature of funds going in and out of private companies in particular.
And that's the tax roundup for this month. Keeping on top of change is always difficult, and understanding the practical implications of that change is even more so when you're working in public practice. If you're not a member of Knowledge Shop yet, give us a call on 1800 800 232 and we can show you how much easier life can be. Talk to you soon.